Well, good evening, everyone. My name is Michael Lewellen, and I'm with OJM, and we thank you for taking the time tonight for this joint webinar with the OJM Group and McBrayer Law Firm. As you can see, your presenters tonight are myself. I am the Director of Financial Planning at OJM Group, Carole Foos, the Director of Tax Planning, Trigg Mitchell, a Senior Associate, and Terri Stallard, a Partner at McBrayer. Tonight, we are going to be covering the Fiscal Cliff and what that means to you from a tax perspective. Terri and Trigg will also hit on it from an estate planning perspective, and then they'll also cover just some things that you need to be doing and how that correlates from an asset protection and estate planning. And then we'll also have a short discussion about the importance of comprehensive financial planning. Again, we thank you for attending. We will, as you can see here, on our next slide, the disclaimer that we have to put up there. You have the ability to ask questions tonight on the side there, so as you have questions, please feel free to answer them, and we will answer them as we can. If we can't get to them on the call, we will address them afterwards. As you can see on here, here's just some material to kind of give you a little bit of background on OJM and kind of what we have available to you. What you're looking at there are books that we have written. We are hopefully going to begin the Kentucky book shortly in conjunction with McBrayer is the hope. We also have, for anyone on here that is not a physician, that's okay. We actually have a book, Wealth Secrets of the Affluent, that we can get you as well too, and I promise you all the material that we are covering tonight will be applicable for the medical and the non-medical tonight. So with that, we will hand it over to Carole Foos and let her take over with what we're looking at under 2013 tax law. Carole?
All right. Thanks, Michael. So, I'll preface this by saying here we said at December 5th, and this is what we're looking at under 2013 tax law today. Could it change? Maybe. But, it's not looking like Congress and the President are getting any closer on their negotiating on the fiscal cliff. So we're going to explain to you where things stand right now. We're going to talk a little bit about some of the budget proposals and then talk about how you can minimize the effect of the upcoming fiscal cliff. So in brief, for investment income, we're going to cover what's happening with capital gains, dividends, and passive income. On the investment income side, what you're facing is under Obamacare a new surtax, on net investment income that is equal to 3.8%. And that's going to apply to taxpayers who make, if they're married filing joint tax returns, taxpayers who have modified adjusted gross income of $250,000 or more, and single taxpayers who have modified adjusted gross income of $200,000 or more. So as you see on the slide, right now long-term capital gains tax rates move from their current 15% to 20% on January 1st. In addition, that 3.8% Medicare tax will apply to long-term capital gains, making the rate for higher income taxpayers 23.8% in 2013. Dividends, currently we have the benefit of having what we call qualified dividends, generally dividends on U.S. stock, which are taxed at capital gains rates right now of 15%. Under the current legislation, if the Bush tax cuts are allowed to expire, those dividends will all be taxed at ordinary tax rates. The 3.8% surtax will also apply to dividends. So dividends on U.S. stocks go from 15% on December 31st to a total of 43.4% for taxpayers in the top bracket on January 1st. So Michael, next slide. Okay, tax-free investments are going to become more attractive, obviously, because they're tax-free and because they're also not included in calculating the surtax. So for passive income, the 3.8% surtax applies to interest income, net rental income, annuities, royalties, and also to your flow-through income from activities without material participation. So if you are a passive investor in an S corporation or partnership and you generate income in that entity, that income will be subject to the 3.8% surtax in 2013. Next slide, Michael. So as we mentioned, this is who's affected by the surtax. Single taxpayers with modified AGI over $200,000 and married taxpayers with modified AGI over $250,000. When you think about some of the percentages, I think it's a little bit mind-boggling. So the top ordinary rate is going from 35% up to 43.4%, which is really a 24% increase. The top capital gains rate goes from 15% to 23.8%, again, a 58.6% bump. The top dividend rate goes from 15% to 43.4%, which is a 289% bump. And the estate tax exemption goes from $5.1 million down to $1 million, and the estate tax rate jumps from 35% to 55%, which is a 57% bump. So what about deductions and exemptions? Unfortunately, I wish I could tell you that those income tax rate increases were the only bad news coming, but we are, under the expiration of the Bush tax cuts, also going to see some loss of deductions and exemptions. The marriage penalty relief is set to expire on 12/31/2012. What that is it used to be that it was really more beneficial for two taxpayers with the same, or with incomes, to file as two single taxpayers versus filing a married filing joint tax return. Bush tax cuts provided relief for that penalty. Again, that relief goes away starting on January 1st, 2013. We also have reduced standard deduction amounts for 2013 and reduced itemized deductions. So as you can see, for high-income taxpayers, itemized deductions will be reduced by 3% of the amount that your adjusted gross income exceeds a threshold. So that's up to a maximum of 80% of your itemized deductions could be lost in this way. Personal exemptions will also be phased out starting in 2013. So what do you do about minimizing the effect of these tax increases? There are certainly some things to be thinking about here in the next 3 weeks before the year ends. One thing would be realizing large capital gains now in 2012 versus 2013. You might want to actually what we call harvest capital gains, meaning if you've got stock in a gain position, sell the stock now to recognize the gain in 2012 and then reinvest in the same or similar stock after the sale so that you have increased basis in that stock, so less gain will be subject to the higher capital gains rates next year. Also, if you have an option of whether to take a bonus now in calendar year 2012 versus 2013, you probably want to go ahead and recognize that income and take the bonus in 2012. Cash basis taxpayers, normally I'm telling my clients to pay expenses now, get the deduction this year. Well, this year, try to delay your expenses and pay them in 2013 so that you get the deduction at 2013 and get the benefit of that deduction at the higher tax rate. Also, once we're into 2013, if you've got a large capital gain transaction and you have the ability to utilize an installment sale method where you're recognizing the income over several years, that's going to be even more beneficial in 2013, especially if you're someone who's on the bubble and maybe is close to meeting that AGI limit that makes you subject to the surtax. Another thing as far as your retirement planning goes, it's really a good time to convert to a Roth now in 2012 versus 2013. On a Roth conversion, you are taxed on the value of your account at the date of conversion. So if you're converting a traditional IRA to a Roth, which anyone at any income level can do, that's going to be taxable on the date of the conversion at the value of the date of conversion. So certainly you're better off taking that and paying the tax at the 2012 rates instead of the 2013 rates. In addition, again, if you're in that bracket where you're not quite at the threshold for having to pay the surtax, you want to plan for your pension and retirement income in order to keep yourself under the threshold if possible. Also, maximizing the use of highly deductible retirement plans, such as a defined benefit plan, in 2013 is going to be an even greater benefit to you, as will deferring compensation in 2013. So to the extent you can put off or that you can participate in a deferred compensation plan and put off paying tax on that compensation to a later date, that's a good thing. So there's also hybrid non-qualified plans that you can participate in that can be a great tax planning tool. These are good because they've got some of the elements of a qualified retirement plan and other elements of a non-qualified plan. They provide a partial current tax deduction, so you get a tax deduction for some of the money that goes into the plan today. You get no tax on the distributions, and it certainly makes a lot of sense if you expect your tax rate to be higher in the future than it is today. So those can work well and provide some great planning opportunities for reducing current income as well as reducing income that's subject to future tax rates if you believe, as I tend to believe, that tax rates are probably going to be higher than 35% when I'm pulling my money out in retirement. A captive insurance company is another great tax planning tool. A captive insurance company is an insurance company that you own. It's generally formed in order to obviously protect against risk. It's a real insurance company. It's a small insurance company. And there's a section of the Internal Revenue Code that allows captive insurance companies to realize up to $1.2 million each year in premium revenue tax-free. So, if you've got a company that you own that's paying for insurance coverage now, maybe you've got some uninsured risks, or you've got policies that are, you have to pay deductibles on. Sometimes you can set up your own insurance company to insure against currently uninsured risks or gaps in your coverage. You pay the premiums into your captive insurance company that you own, the legitimate business expense, so your company deducts that, gets an ordinary tax deduction for it, and then your captive insurance company receives the first $1.2 million of that premium revenue on a tax-free basis. This is generally meant because, obviously, it's an insurance company. It's expensive to set up. It has to be licensed by a state Department of Insurance, lots of rules and regulations to follow. So we generally tell clients that this is something that's meant for a business that's got $3 to $5 million of gross revenue before you start thinking about a captive insurance company. But again, a great tax planning tool. $529s and tax-free investments also are looking good for 2013. 529 plans for college savings allow you to put after-tax dollars into a fund. They grow on a tax-deferred basis, and as long as the money is pulled out and used for qualified higher education expenses, those distributions are not tax-free. In addition, distributions from a 529 plan are not included in adjusted gross income. Therefore, they don't push up that modified AGI to push you into a bracket that's subject to the surtax. Roth conversions are also attractive because with a Roth IRA, unlike a traditional IRA, there is no required minimum distribution. So again, in years where you're trying to keep your income below the level that's subject to the surtax, you don't want to pull money out of an IRA that you don't need. So a Roth conversion makes a lot of sense from that as well. Municipal interest is also certainly more attractive since it also does not add to the modified adjusted gross income that is used in calculating whether you're subject to the surtax. You know, certainly municipal interest, it's a great thing to have as part of your investment portfolio, but I always tell clients you got to look for the investment side of it first. The tax rate's still around 100%, although I feel like we're getting closer to that 100% tax rate every day at this point. So cash value life insurance is also a good tool for protecting yourself against these tax increases. With a cash value life insurance policy, the investment growth is not subject to either income tax or to the surtax. Index products have downside protection. Most of these types of products have a 0% floor, or lots of them do. So if the market, they're invested in an index product and the market drops by 20%, you're just going to stay at 0. So people who had those products in 2008 generally thought they were great. Also, the cash value can be accessed tax-free. So again, it's nice to have that growth be tax-deferred and then be able to pull the cash out on a tax-free basis. Makes a lot of sense in a high income tax environment.
Perfect. Well, thank you, Carole. I know we'll be moving on to the asset protection and estate planning section now with Trigg and Terri. I think, you know, one point, and really what Carole was getting at as she was walking through that, something that's important that we tell clients a lot of times is tax diversification. So having the ability, having different buckets where vehicles are being taxed differently, that's something that we tell clients is important, and it's going to become even more important if we enter a period of time where tax rates are going to be going up. None of us know where tax rates are going to be 30 years from now, so that's what I tell clients. If I knew where things were going to be, I would tell you to put all of your money in, you know, A, B, or C bucket, but we don't know. So, you know, we like to stress to clients the importance of tax diversification. So, but thank you, Carole. We appreciate your time tonight. We hope everyone found what Carole had to say beneficial. If you have any questions, again, feel free to put them in there, but we're going to move on to estate planning and asset protection and really how those two can work together. And I will hand it over to Trigg and Terri now with McBrayer.
Thanks, Michael. As Michael was mentioning, the focus of our portion of tonight's program will be to kind of address the interplay between the need for asset protection planning along with estate planning. Kind of feel like doing estate planning without any asset protection planning is akin to you know, putting the cart before the horse. What I mean by that is, you know, the whole purpose, or one of the main purposes of estate planning is to preserve your wealth and you know, provide for a spouse or you know, your other loved ones. But if there are no assets to pass to your spouse or your children, then all the fanciest estate planning in the world doesn't do you any good. But by implementing various asset planning protection instruments, you can make sure that you do have wealth to pass to your your spouse and your children when the time comes. This is a presentation, geared towards physicians, obviously, and physicians are one of the better paid professions in the workforce, and they have the potential to accumulate some degree of wealth. So that's the good news. The downside to that is because we live in a litigious society, and everybody's looking for ways to make a quick buck. Doctors have become a target of frivolous lawsuits, and because they're viewed to be people that have deep pockets and the ability to pay, whether there's any merit to the claims or not. And without proper planning, if a doctor gets sued, then they could be putting their personal assets as at risk. But with proper asset protection planning, you can protect and preserve your wealth and have a nice nest egg when you retire, and then to pass on to future generations. So the first thing we'll do in more detail is look at the various asset protection planning mechanisms, and then we'll transition into estate planning. So Michael, if you could cue the next slide, please. Great. So now we'll just talk about, give an overview of the various types of asset protection. There's limited liability entities. You have insurance, asset protection trusts, and then beyond that, there are certain asset classes that are protected from your creditors, and we'll identify or go into each class in a little more detail. The limited liability entities gets various choices for operating your practice. I don't think anybody necessarily in the right mind would do this, but have sole proprietorship, have partnerships, professional service corporations, and professional limited liability companies. It would almost be unthinkable to operate as a sole proprietorship or partnership, because when you operate as one of these entities, you're putting your personal assets at risk. Neither one of these entities provides for a entity-level protection of assets, whereas a professional service corporation or a professional limited liability company does allow for protection of entity assets. In the case of a PSC or a PLLC, provided that the various corporate formalities are followed, a creditor of the entity will only be able to get to the assets of the entity. They won't also be able to get at the personal assets of the physician. And when we mention the formalities, one of the biggest things to keep in mind is, in order for that corporate entity to be respected, that you can't mingle personal assets with the business assets. And when you do so, you put your personal assets at risk, often referred to as being able to pierce the corporate veil. Insurance, I think of this as one of the main lines of defense for a physician. The benefits of being adequately insured are many. One of the main benefits is that in the event someone files a claim, whether or not it has any merit, you still have to defend it, and most insurance policies will cover the legal fees associated with defending such claims. Go ahead.
If I could interrupt too, insurance is very important to all types of, I think, clients, because if there are business assets involved, you have a child that may be involved in a business or taking the business over, you have other children who are not, then to equal what those children are getting upon your death or receiving, insurance is a really good way of funding that. So one child gets the business, the other child gets equal amount of cash, so that the child receiving the business is not working for their siblings, which could cause problems down the road.
That's a great point. And another benefit of having the insurance in place, especially as it relates to claims against the physician, is it provides the policy limits provide a pool of money for settling claims against the physician, and as a result, you don't have to come out of pocket for any judgments. Another nice thing about having insurance in place and being adequately insured is that in the majority of instances where a claim is filed against a physician who is properly insured, the claim is going to get settled without having to go to the time and expense of going to a trial in a protracted litigation. You know, there's many types of insurance coverage, professional negligence, directors' officers policies. You know, you can even get coverage for workplace claims for harassment or discrimination, heaven forbid. One point I would like to make about the slides is these asset protection trusts that I mentioned. Two things where I indicated that Ohio currently recognizes asset protection trusts. That is not entirely accurate. There is proposed legislation where they will recognize the trust, but it has not been fully enacted yet. So that is something that's in the works. And Kentucky has also proposed legislation for asset protection trusts, but is not as far along in the process of as Ohio is. One of the beauty of an asset protection trust is historically when you're dealing with a self-settled trust, the assets of the trust won't be protected from the creditors of the settlor. So in the past, if a physician settles a trust or establishes a trust, the assets that the physician puts into the trust and still has control over would be subject to the claims of a creditor. But with the asset protection legislation that's being proposed in Ohio and Kentucky, that would change, and the assets of a self-settled trust would be protected from the claims of a creditor. Terry, did you have something you wanted to add?
I just had a question. Does it depend on whether he benefits under the trust, or is it just the control?
I don't know. I don't believe it does. I think you can still have control and still have a spendthrift provision in the trust. So it's another great feature of these asset protection trusts. Another class, another classes of protected assets, retirement plans, life insurance policies, cash value of life insurance policies. Those are protected from creditors. Gifts to family members, whether they be outright or in trust, are generally protected from creditors as well. The one caveat to the gifting scenario is it can't be done to avoid or to thwart a creditor. If the sole purpose is to circumvent a judgment, then most likely that gift will be clawed back, and the creditor will be able to access such assets. Something that physician practices should consider with respect to giving additional layers of protection to their assets is the possibility of setting up multiple limited liability entities. Say, for example, the practice owns the office space where it operates. The practice owns the equipment that they use to perform the medical services. The practice has an accounting department that provides billing services, and of course the physician who provides the medical services. Then one thing you can do to spread the risk and protect those assets is create an LLC kind of for each facet of the business. For instance, Entity 1 could own the real estate of the practice. Entity 2 could own the equipment of the practice. Entity 3 could be a billing service. And then finally, Entity 4 could be the medical services that are being provided by the physician. And because each entity's ultimate exposure for loss is limited to the value of its assets, if you spread, let's say, $1 million worth of assets, and just for the sake of clean math, apportion $250,000 worth of assets to each individual entity, then the effect of what you've done is reduce the exposure from the medical practice to $1 million under a combined entity down to $250,000 for an entity who only provides medical services. And then another thing you can do to reduce the income from the medical practice is have the medical practice lease the office space from the real estate entity. Have the medical practice lease the equipment from the equipment entity. Have the medical practice pay for the billing services of the accounting entity, so on and so forth. And for that matter, you could potentially afford yourself some additional protection from your personal assets by placing them into an LLC. Michael, I guess with that, we'll forward to the next slide. What we see as common kind of estate planning mistakes made by physicians. The first bullet point you see there is doing nothing, and I think physicians of all professionals are some of the busiest. They work longer and harder than just about anyone who punches the clock for a living, so to speak, and they don't often think of the kind of the immediate need for estate planning because they're not going to pass tomorrow, so there's always going to be time to do it down the road. And the risk you run when you do nothing is that if there is no will in place, then your assets will pass according to the laws of intestacy, and that might not be, for a number of reasons, how you want your assets to be distributed upon your passing. In addition, they go outright and free of trust. So in the event that you have an 18-year-old child, that child could potentially be getting hundreds of thousands, if not millions of dollars without the safety net of a trust to essentially protect the young child from him or herself. And depending on the size of the estate, you could be missing out on advantage of taking full advantage of the estate tax exemption whatever that happens to be at the time. Another mistake that we see from time to time is failure to rely on an expert. To use an example that maybe you guys could relate to, I would not go to a dentist to perform my open heart surgery, and it's probably not in your best interest to go to a trial attorney to draft your estate planning documents. We deal with these things on a daily basis, and we are, paid to stay on top of the laws and make sure that your documents properly reflect the current status of the tax law and also carry out your intent. Another problem that we run into from time to time is people who executed their wills 20 years ago and haven't pulled them out of the safe deposit box since. A lot has changed in the last 20 years, not to mention the fact that the state tax exemption has gone from $650,000 at the time to $5 million as of today. And the state tax planning that was necessary for an estate of $1.5 million isn't necessary with the estate tax exemption being $5 million. So you could potentially be tying your assets up unnecessarily if your plan was developed for a state tax exemption of $650,000. Another problem you run into if you're dealing with an outdated plan is what happens if you executed the documents before you had children and there were no provisions in your will that named a guardian for your minor children. If you had children after the documents were executed, then you're leaving the in the event of a simultaneous death of the husband and the wife, you're leaving it up to the courts to decide who's going to take care of your children. And obviously that's not something that you want to leave in the control of the courts. And that, it's a practical matter as well. If it's been a while since you've updated your plans, your executor, your trustee designations could be outdated. I know I have a lot of young couples who are most comfortable with naming their parents as the executors of their estates. But oftentimes if you put your wills away, don't do anything with them, 10, 20 years passes, and those parents are now deceased, and there's not a properly designated executor or executrix for your will, and you can't get it probated. Beneficiary designations. This is a big one, and it's not one that people give a whole lot of thought to, but they should. Just go through a couple of problems we see with beneficiary designations. If you have a life insurance policy, you have a retirement plan, for whatever reason you fail to designate a beneficiary, then the assets from that retirement plan or life insurance policy will be pulled back in and become an asset of your estate, and this can cause some unwanted tax consequences. Let's say that you are in a second marriage and you haven't updated your beneficiary designation since you got divorced. Well, if you name your first spouse as the primary beneficiary of a life insurance policy and you don't change that after your divorce, then you're probably going to be left with an unintended beneficiary of the policy. Another problem that we see from time to time is clients will identify the spouse as a primary beneficiary, and then they'll name the child as a secondary beneficiary. And this is fine if the child's 25, 30 years old, but what if the child's 10 to 15 years old? If you don't specifically designate a trust for the benefit of the child, then when the child turns 18, that money goes to them outright, and they're free to blow it on a sports car, lavish vacations, whatever. They're probably not going to pay for tuition or buy books with it. I think Michael is going to wrap up the presentation with the necessity for clients to coordinate with all their advisors, financial advisors, CPAs, attorneys, insurance, so on and so forth. And the main benefit of doing that is it allows your advisors to get a better and more complete picture of what your assets are, what your particular familial situation is, and as a result, we're able to better tailor an estate plan that is going to specifically fit your particular circumstances. Another thing, this is something that not a lot of people give a whole lot of thought to, but more and more financial institutions are doing away with paper statements. It's all digital these days. So it's possible for a spouse to have a bunch of accounts in various places. They don't get a digital statement. They pass. The surviving spouse isn't aware that these accounts are out there, and maybe they don't get listed. Maybe they don't get passed according to the provisions of the will, so on and so forth. So what we recommend that clients do is, any case where there is this digital asset, that you prepare a spreadsheet that lists the account name, the institution where the account is, the account number, the username, the password to access the account. And what this is going to allow your surviving spouse to do is just more properly and adequately gather all the assets of your estate. So where to start? Worst case scenario, say you don't have any of these documents in place. The good news is, if you're listening to tonight's webinar, then it's not too late to get these assets or these documents in place. And for physicians especially, we want to put together a packet that consists of general power of attorney, healthcare power of attorney, living wills, depending on the size of the estate, or for various non-tax reasons, may suggest a trust. Always a good idea to have a buy-sell agreement, and we just touched on it, but I think it's important to revisit your beneficiary designations. I won't go into intricate detail to all these documents, but just briefly, power of attorney basically lets your attorney, in fact, step into your shoes in the event of your incapacity or inability to act for whatever reason. You're out of town, real estate closings happening while you're out of town. You have the power of attorney, authorize your attorney, in fact, to sign real estate documents for you, conduct banking transactions in your place, et cetera, et cetera. No need for me to tell a physician what a healthcare power of attorney or living will does. The will, it just provides for the disposition of your assets upon your passing. It gives you the opportunity to name the executor of your estate, name the trustee of any trusts that are created under your estate planning documents, establish a guardian for minor children. And one of the things that we're fond of doing is, especially in the case of children who haven't reached the age of 30, is establishing within the will a trust for the minor children that calls for distributions of the assets of the trust staggered, half at 25, half at 30, half at 30, half at 35, whatever it is that you decide. And these trusts for your children also allow us to account for any special needs that your children might have. If it's important to you for your child to get a 4-year education or even a professional degree before they're able to benefit from their inheritance, then we can work those concepts into the trust. The sky's the limit. It's really as broad and varied as need be. I guess the buy-sell is it's one of those things where it's just a lot better, a lot less hassle if you go ahead and just do it up front. If for no other reason, it gives you the peace of mind knowing that when you pass, there will be a mechanism in place for your spouse to receive your fair share of the practice that you've worked so hard to build. I guess with that, we'll transition into the status of the estate tax exemption. This fiscal cliff that we're facing is making it nearly impossible to predict where the estate tax exemption is going to wind up. It's currently $5 million with a marginal rate of 35%. If the cliff takes effect, we revert back to a $1 million exemption with a 55% tax rate. And I was reading the Wall Street Journal over the weekend, and it appears that President Obama is proposing a reduction of the exemption down to $3.5 million and a increase in the tax rate from 35 to 45%. So the bottom line there is unless your estate is less than $1 million and you know it's going to be less than $1 million when you pass, it's something that you need to actively monitor and stay on top of and be aware of, because depending on where the exemption amount lands might require you to revise your estate plan for purposes of implementing some tax planning strategies. And Michael, with that,
Perfect.
hand it over to you.
Yeah, listen, I appreciate it. I mean, obviously, all of the information that you shared. I'll give a little bit of background here in a minute on OJM, but we have attorneys and so forth in house, but what we don't do is prepare legal documents or draft legal documents. So the importance of all the things that Trigg and Terri just hit on, I would definitely second. I mean, I think those are things that we deal with. Obviously, a lot of physicians, a lot of business owners, and I think sometimes people expect that they may have those things in place, and a lot of times that they don't, and that's extremely important to do that. To wrap it up, I think Carole hit on it, Trigg and Terri hit on it a little bit, but one of the things that we find extremely important, especially at OJM, is the importance of a multidisciplinary plan or a coordinated approach to planning. You can see on the little pinwheel there all the different areas listed there. To give you a little bit of background for those of you that don't know how OJM works, we are a consulting firm that sits on top of a financial service firm, and we take our clients through a very defined planning process. So where we're looking at asset protection, tax, investment, retirement, financial insurance, and you can see benefit planning, corporate structure, all of those things on there. We have a team that includes Carole, David Mandel, one of our partners, is an attorney and specializes in asset protection. But to Trigg's point earlier, we don't prepare tax returns and we don't draft legal documents. And the point that what we really encourage anyone to take away from today's discussion, not only the great information that was provided by the other speakers, but the importance of really looking at your situation from a multidisciplinary standpoint and coordinating with your other advisors. I tell clients a lot of times when they come to us, we're not a one-stop shop. We work with physicians and business owners all over the country, so you need your attorney, you need your CPA, but really, what you want to make sure you do is have someone that's quarterbacking that process and that's doing that. And that's something that we do for clients. We'd love the opportunity. Some of you on here have been through our planning process, so you know how it works. For those of you that haven't, if you want to learn more, we would definitely be open to that discussion. But we can't stress enough. I tell clients all the time that come to us and they've implemented tax strategies or estate planning strategies, and they may have ignored the financial aspect of it, or the other way around, whatever it may be. And it's so important to maximize and to be as efficient as possible that all of your advisors are communicating. Now, what we have next is a little poll, and you can see on there kind of what's the best next step. And I'll take a minute and let everyone answer on that. It's simply just, if you'd like a copy of For Doctors Only, or if you're a non-physician, obviously Wealth Secrets of the Affluent, we would encourage you to request a copy of that. If you've heard something today that you want more information on, whether it be the tax stuff that Carole hit on, the estate planning, the asset protection that Trigg and Terri hit on, we would encourage you to request a consult, and we can definitely get that signed up, or they can definitely get you connected with whoever needs to be connected in that regard. We also, if you want to sign up for either of our newsletters, OGM has a newsletter, McBrayer obviously as well too. Obviously, half of you that are on here know that. The other half of you get ours as well too. If you want to get signed up for those, we can do that as well. But other than that, we just really appreciate everyone taking the time, and hopefully you found it beneficial and somewhat educational, because that's the goal. And again, just to reiterate the point that it's important for to make sure you're coordinated and that you are working with your advisors as a whole, and that's what we're trying to present to you tonight, is advisors that are working together, and we would love the opportunity to chat with you, the McBrayer and OGM as well too. So with that, I will end the webinar. I thank everyone again for their time. We'll get your request out to you. If there are any questions that we go back and look and see that were unanswered, we'll definitely address those, but we'll leave the poll open for a little bit, let everyone request what they want, and we'll go from there. Thank you again, and have a good night.